Welcome to the Web3 Native podcast, where we dive deep into the ideas, people, and technologies shaping the future of Web3. I'm Emma Cui, and each episode we will sit down with founders, builders, and thought leaders that are shaping the frontiers of Web3. Together, we will explore what it really takes to build in crypto today and where the next wave of innovation is headed. As a reminder, none of the discussions are meant for investment advice. So, welcome back to the Web3 Native podcast. Today, we're very glad to host Semignac, the co-founder of previously InstaDepp, now Fluid, a leading DeFi protocol. Semignac and his brothers are truly OG DeFi founders since 2019. And we're extremely happy to have him here. And Semignac, welcome.
Yeah, thanks for inviting me. Yeah, it's been long since we've been in the industry. Now probably if the bear market is started, then this is probably going to be our third bear market. So yeah, I mean, excited to be here. Yeah.
In one sentence, could you please describe what is Fluid today and what problem is it trying to solve?
Yeah, so Fluid, as I call it, is an ever-evolving DeFi protocol, and the way we architect it is like it should be a single protocol which serves all financial needs. It's a money market right now. It's also a DEX, but you can expect it to be a perp and credit-based protocol options, and everything that you can imagine in finance. It should be able to satisfy those needs. So as we go on, it will mature, add more protocols. But basically, in single sentence, it will be like a what we call it as is like a base for future financial system.
Wow, that's some
Yeah.
ambitious statements out there. If we were to drill down a little bit to today, what's the snapshot of Fluid today? I know you have the ambition to incorporate many more financial functions into Fluid, but what are the key functions that Fluid has to offer today?
Yeah, so as I mentioned, it's a money market and a DEX right now. We are
Yeah.
launching our DEX V2, which the timeline for that is by the end of this month, if nothing gets delayed. So yeah, DEX V2 is on the line. So currently it's a money market, it's a DEX, it's the third biggest money market with active loans, and then it's the second biggest DEX on Ethereum. And I think we often come as in the top five DEX by volume across all chains. So yeah, I mean that's where we are at right now.
Amazing. Before we dive deeper into the product and the architecture, I would also love to spend a couple of minutes to understand your DeFi journey or your crypto journey. I mean, we've met since I think back in 2019, but I would love to hear from you what got you into crypto.
Yeah, so we actually we went to a Ethereum hackathon. We were like lightly involved with the Ethereum before that, just learning Solidity, doing things. We went to our first hackathon in ETH India in 2018, where we won the hackathon. Our team name there was InstaDapp, and it basically came out as like, oh, it was a hackathon. We had to create some dApp instantly. So we just kept it InstaDapp, and then it was a wrapper on top of Maker to simplify MakerDAO. And then later we launched InstaDapp, which was like simplifying. It was a middle layer and simplifying whole of DeFi. The goal for that was to simplify all the money markets and some of the DEXs. So yeah, later it became InstaDapp as after a few months since the hackathon. And yeah, we continued it. We did a lot of DeFi innovation. We were the first one to create flash loan based strategies. In the DeFi, we created the concept of refinancing. We brought in the composability. We created the smart accounts. which is now like a whole industry known as account abstraction and so on. So yeah, we went through a lot of things, invented a lot of new things in the DeFi in the early stage. The limitation for InstaDepp was like it was a middleware protocol. We did a lot of innovation, but we had more ideas to do changes in the underlying protocols. But as we did not own them, we could not do changes. So that's how we came to Fluid, where we ideated and thought on how the best protocol can can look like how can we design a protocol which is just connecting everything into a single layer. So like instead I was trying to connect everything into a single layer, but it was above on top of those protocol. But how can we do it on the protocol level itself? So if you see Fluid, like it's like instead I was on top of protocol, but Fluid is below the protocol. Like it's the liquidity layer on top of which we build different protocols, which serves all the
Yeah,
needs. So yeah,
yeah,
so we aggregated everything. We
yeah.
yeah, allowed a lot higher capital efficiency, created a lot more.
Before
Yeah,
maybe
yeah,
we
yeah. Sorry,
will
sorry.
before we dive deeper into the architectural designs, right? I just want to point out like how young you guys were from memory. I think back then you guys were still doing university, right? And both of you dropped out after the
Yeah,
hackathon.
yeah, yeah, yeah.
Yeah,
I was
and
18 years old. Yeah, yeah, and
oh
Soumya
my
was 20.
God. Okay, but so you're still in your early 20, even after going through two full cycles of crypto,
Yeah.
being a true
No,
OG
I
in this
won't say
space.
early. Yeah, I'm 26 now.
Okay,
But when
okay,
we
just
started, I was
across that.
18. Yeah, yeah,
Okay,
yeah.
that's amazing. I think that really brings to life what kind of what kind of opportunities crypto offers,
Mhm.
right? It really offers this kind of
That's true. Yeah.
level playing ground for builders all across the world. And I have to say, I'm so glad you guys built through the last bear market because you guys were early to DeFi, right? You were truly DeFi
Mhm.
OG. You built InstaDApp. You managed to raise seed fund from Pantera. You also managed to raise, I
Mhm.
think, the next round in 2021, right? A pretty big round back then from well-known people, Baji, Coinbase. I think we also putting a ticket in there, but you guys were
Yeah.
super early, and then market come crashing down, and a lot of the teams stopped building, and the base assumption
Mhm.
is people got rich, maybe retired and whatnot. And
Yeah.
I think but you guys didn't kind of fade out from the whole space, right? You continue to build, and I think it's in what, early 2024. I can't remember the detailed time when you guys pivoted to Fluid and relaunched
Mhm.
this whole new product. Of course, a lot of the learnings
Mhm.
and kind of continues the original vision of InstaDApp. But I just have to say, felt so glad you guys built through that bear market and show people, it's not always about money and getting rich quick in crypto. You can actually build solid product that accrues value and generating revenue.
Yeah. Yeah.
So yeah, I just want to put that one out there. Um, what is the biggest architectural lessons from InstaDApp that shaped Fluid's design?
Mhm.
I think you were going there a little bit, but just kind of maybe we can talk about this point
Yeah. Yeah.
a bit
Yeah.
more.
So, yeah. So on Instadap, we aggregated all the different protocols, and we innovated on top of the protocols. We brought in a lot of like, you can move your positions easily between the protocols. You can use these flash loan strategies and so on.
Mm,
Um, but as I mentioned, like it was quite complicated, or like we had a lot of ideas to do a protocol level innovation. For example, Aave launched Aave V2, and then Aave launched Aave V3, and then Aave asked all the users to migrate from V2 to V3. Similar thing happened when Compound launched from one version to another, and Aave V2 was like still bigger than Aave V3 for almost about a year till Aave V3 become bigger. So there was like it creates a lot of friction every time you do something new or launch the same thing but in an upgraded version, and you ask all the users to move. But if your bank does an upgrade or something, they won't ask you to move. Like, they'll just do the internal updates and so on. But in DeFi protocol, it wasn't like the architecture didn't allow this. And
Oh,
what
yes, I
we
remember.
yeah
Because you have to kind of unwind the whole position, right?
yeah yeah
Yeah.
Yeah. Yeah, and then you want lenders to move, and once lenders are move, then borrowers will move, then again lenders will move. Like not all the lenders can move once, and then borrowers. Like it needs to be like in a
Yeah.
balanced way. And so
Yeah.
there was a lot of friction. We thought like, how can we design a protocol where we can launch as many versions as possible without asking users to move. We can create many different protocols that were not possible before, like our DEX and our smart debt, smart collateral concept. We can create perps on top, we can create different protocols and so on. So that's how we like thought like, how can we create a protocol which is really ever evolving in nature. And we came to the conclusion of the fluid architecture, where we are aggregating everything in the liquidity layer, where all the liquidity sits, and on top of that we can build infinite protocol. So all the liquidity stays here, and this contract will be here forever. And on top of that, we will keep on launching different new protocols, different new versions of existing protocols, and many different innovations. So that's the main thing. Like I just feel that the fluid protocol will probably hold at least tens of protocols, or like if we take more optimistic scenario, then maybe hundreds of protocol in next 5 to 10 years. It can be minor or major protocols, different protocols serving different needs. But yeah, that's the whole inspiration to launch
Mm.
Fluid, like how, yeah, uh, to create a proper financial instrument. Yeah.
That's amazing. I feel like you guys have this
Mhm.
grand vision of what fluid could be. But when you
Mhm.
first started, it was inspired by real problems that you were facing, right? During DeFi summer. So it
Yeah, yeah.
came from real user pain point. I myself was a early DeFi
Mm.
user. I definitely used the one-click migration you were talking about, right? From
Yeah.
Aave version 2 to version 3. It just seems like a much better cost efficient way to do it. And I have a couple of questions regarding other architectural designs of Fluid, right? One is regarding the designs of smart collateral and smart debt. So
Mhm.
essentially, I think you guys have this design that lets collateral of debt act as liquidity via smart collateral and smart debt. So, and then people can kind of use this liquidity to enable users to earn while borrowing, right? And borrow LP tokens to earn yields.
Mhm.
So that's one. And then
Mhm.
secondly, you guys also talk about you're able to support higher LTVs with lower penalties compared to
Mhm.
peers. So
Yeah.
are you able to kind of walk us through the design?
Yeah, yeah. So smart collateral and smart debt is
Mm,
something, a whole new sort of financial primitive that we invented. Um, Smart debt is something a bit more sort of innovative here. Smart collateral is easier to understand. But smart debt is something we call it as sort of inverse LP. I'll get to that, but in a generic sense, smart collateral is basically an LP position which also earns lending APR and also earns trading APR while you can use it as collateral. So it's like three in one. You can use
mm,
it as collateral, you can earn lending APR, and you can also earn trading APR. And on the debt side is, when you borrow smart debt, then you pay borrow rate, but you earn trading APR on it. Uh,
mm,
so so like if you borrow, let's say, stables on Aave or Morpho anywhere, you can still borrow the same amount, but you cannot get any discount on your debt. But here you can, like, let's say, borrow USDC USDT as smart debt, and traders can trade using your debt. Traders can trade between USDC and USDT, and as they trade, you get a trading discount. Like, as they trade, they pay trading fees, which reduces your debt. So in a regular LP position, when a trade happens, your LP position increases in value. In smart debt, when a trade happens, your debt decreases in value. So
got it.
trading fees
Got it.
pays back your debt. So as
Yeah.
more and more people trade on debt, your debt
Yeah.
decreases. So
Yeah.
like, let's say the borrow rate in the ecosystem is going as 5%, and let's say the trading APR of USDC USDT on Fluid is going as 2%. Then your effective borrow rate on Fluid to borrow stables is 3%, 5 minus 2. So
Yeah.
our smart debt pool has a very, very high demand. Like currently, 50% of overall Fluid's trading volume goes through smart debt. And our pools are always at like 100% caps. Like it's always filled. The moment users leave, a new user comes and take it. Just a very high demand because it's basically allows you to get discount on your debt, which sort of never technically existed in the whole financial world. Like, that is something you pay interest on, but here you can also earn on
Got
that
it.
debt.
Got it.
So
So if I were just to kind of rephrase a little bit, so
yeah,
essentially, in addition to the normal collateral and debt you have within a on-chain lending protocol, now you're allowing the users to add on one layer of yield. Basically, those positions can be used as LP positions index, and that
yeah,
yield can be used to reduce the debt if you're holding debt,
yeah,
or adding on yield to the collateral if you're lending, if you're borrowing.
yeah.
Yeah. Awesome. That's pretty cool. Do you think it's because you guys are building 3 products at the same time, and hence you're able to achieve this kind of DeFi Lego effect more effectively,
Yeah,
right?
that's
Compared
true.
to, Aave is building lending, Uniswap is building DEX. If you want them to achieve this kind of integration, I guess a lot more coordination what needs to happen. Do you think that's possible?
Yeah.
It's because you're building 3 in-house.
Yeah, it's because of that. So I put it like this: our DEX is 10 times better because of our money market, and our money market is 2 times better because of the DEX. Like both of them help each other with liquidity, with deeper liquidity. So for example, like our DEX, we do from Fluid side, we do like $0 in incentives, and we are like the second biggest DEX in a very highly competitive stage where there were already so many DEXs. Fluid currently leads in the correlated pair trading. Like we have the biggest market share in the correlated tokens. We're launching DEX V2. With that, we hope to become the biggest DEX in all of crypto. Let's see. But yeah, I mean, DEX V2 will allow users to do a lot more things. But basically, the smart debt, smart collateral thing, it allows such a high capital efficiency. Like with $1, you can create $40 worth of liquidity, and then you can earn $40 worth of fees. Like in your single dollar, you can, you're generating $40 worth of liquidity. That $40 worth of liquidity is generating $40 worth of fees. So so you just get a very like you're basically creating a highly leveraged position where if there is an impermanent loss, that gets magnified. If there is a profit, that gets magnified. So it's basically like providing tools to be more capital efficient. And if your strategy works, you will be highly in profit. If your strategy doesn't work, you'll be highly in loss. Similar to like regular leverage, but it's like a bit more complicated than that. So just yeah, introduced like sort of in simpler words, introducing leverage into LP position, but it's a bit different than those exact words.
Got it. So you talk about leverage. Are there any risk that users could potentially underestimate, or you want to point out for this kind of integration? Because
Yeah.
why isn't Aave and Uniswap just kind of collaborate, right, and do this
So
collaboration?
even if they collaborate, they won't be able to do something like smart debt. Smart debt is purely created out of debt. It's like so just to put it more like uh, let's say you want to borrow $1,000, you deposit 1 ETH as collateral, you borrow 1,000 USDC, let's say from Aave, and you have this 1,000 USDC. You can go ahead and spend it, do whatever you want, and you have this debt here, which will sit there, accrue interest. If you want to close your position, you need to pay back the debt, withdraw the collateral, and so on. But what Fluid allows is this debt, which is sitting here doing nothing, accruing interest. You can earn trading APR on that. So Fluid gives you an option, which is like you deposit 1 ETH as collateral. You can borrow 500 USDC and 500 USDT. So you have like you still have the $1,000, but in 500 USDC and USDT. Your debt is in 500 USDC USDT. You went ahead, spend your $1,000, bought something else, And now here you have a debt of 500 USDC USDT. So now traders can trade on your debt, and it happens something like this. Like, let's say I'm a trader, I want to trade 100 USDC for USDT. I'll come, I'll pay back your 100 USDC debt, and I'll borrow your 100 USDT debt. So your debt will change from 500 to 400, 600. And as traders trade back and forth on your debt, which keeps on changing the configuration of debt, you get trading APR, and you earn sort of on your debt. And it's possible that you borrowed 500, but when you came to pay back, you have to pay back 700, 300 because your debt configuration changed because of the active tradings. So the amount you borrowed and the amount you have to pay back in the tokens might differ because the traders have changed that the market price and everything. So yeah, this is like a something which works as like payback and borrow, rather than like in an LP position you do deposit and withdraw. You deposit one token. Let's say I want to swap ETH to USDC. I will give Uniswap ETH. I'll deposit ETH in Uniswap and I'll withdraw USDC. Like in a regular AMM, it's like you deposit one token, you withdraw another. But in Fluid Smart Debt, you pay back one token and you borrow another. So it can only happen when you have borrowings there. And even if like Aave and Uniswap merges, they cannot technically do that. It's like it needs to be created specially. Like the protocol needs to be architected there is a whole different architecture that's needed.
Oh, it has to happen on day one.
Yeah, sort of. Yeah. So even on day one, we didn't had our DEX, but we already had the plan of this DEX, which came like 8 months later after the first initial launch, and our protocol was already created in such a way that we can create this DEX later on. So
Got
yeah,
it.
so
Got it.
sorry. So yeah.
Yeah. Oh, sorry. Go ahead. I want to maybe move on to talk about what mechanism allows Fluid to support higher LTVs with lower penalties than peers.
Yeah.
What kind of mechanism?
Yeah. So on Fluid, whatever we tried to do, we asked ourselves like, is it like at least 2x better, but target is to have something 10x better and so on. Because if you can do a very high technical innovation, then the growth becomes much easier. It's easier to sell. It's just much better. So as we already dived into the smart collateral, smart debt, which is extremely better. Similar thing we have done is on the liquidation side, where our liquidation engine is you can take it more as like it's 100x better than any other liquidation engine out there. And the reason for that is we redesigned the whole thing such that our liquidation is more like a swap. So uh so when a liquidator comes, liquidator just know that this much liquidation is available. Liquidator does not know what user is which users are there, and so it's basically you do for liquidator, they get a price from the contract and they just do a trade. It's similarly like if you go on Uniswap to swap, you get like what's the price going in the pool and then you do the swap. Similarly on Fluid, they can just come do a single contract call, they will get the liquidation available and they will just pay back. And
But
when
who
they do
determines the price? Who determines the price of this liquidation?
So it happens from the Chainlink Oracle, like it's Chainlink Oracle, what's the price going on? Accordingly, what's the liquidation available? Now, what happens is like the users in Fluid is the blending protocol. They are divided into ticks, and when you do a liquidation, you're basically liquidating these ticks. You're not liquidating each independent user. So there can be like one user, there can be 10 users, there can be 1,000 users. So with a single swap, you can even liquidate 1,000 users without any increase in gas. So for example, when you go on Uniswap and when you do a swap, doesn't matter if the swap has a liquidity of one user, the range order, or it's thousands of users. Your swap costs the exact same gas because you are trading on that aggregated liquidity of all users combined. Similarly, when you liquidate here, you don't liquidate each user, you're liquidating the whole bad debt of the protocol. So you just do a simple single trade which liquidates all users, and then the protocol algorithm just has everything. So if you want to
So
liquidate one user, yeah.
is this considered as a peer-to-pool liquidation, not a peer-to-peer? So it's not like traditionally how other liquidation works, like
Yeah,
you have this position at risk and
yeah.
people come in,
You
right,
you
and
can,
bid for it.
yeah. You can
Yeah.
take it more like the current liquidation in all the protocols is more like limit order, where you can liquidate each in limit order. You fill each order separately, and similarly in current liquidations, you liquidate each position separately, and it's a very tedious work because and only very sophisticated actors are able to do that, because if there are like tens of thousands of users or millions of users, then you need to keep track of all the positions very actively, and then see that this user is in the liquidated stage, then liquidate that user, liquidate this user, liquidate that. And but in Uniswap there can be like thousands of range orders, but you fill all of them together. It's not like you're filling each limit orders. Similarly, on Fluid, it's more like doing a swap on range order or something. Like you're liquidating all users together. You're not liquidating each user. So it's also very easy. Like even with a person with a very little sense of with a very little understanding can even set a liquidation bot, because they don't need to track all the users. They just need to call our contract, get the price of liquidation, and liquidate. It's like
So the implication of this design is, one, you talk about it's going to be much more gas efficient, right?
yeah.
But will they also get a better liquidation price as well? Why?
So for liquidation price, there are many benefits in this. One is like first, the gas is super low, and the gas matters a lot when the market is crashing, and at that time the liquidations are the most. So on Ethereum the gas goes to 100 GUI or 200 GUI, and the liquidation itself are costing like $100. Sometimes it even costs like $500. And so on Fluid, the liquidation to liquidate a user, it costs around 200K gas, while on, let's say, Aave, it costs around 500,000 or 1 million gas. So here on Fluid, you can liquidate like thousands of users at 200K gas, while on other protocol, you will pay like 500,000 in gas just to liquidate one single user.
Yeah.
So that's one of the implication when the market is very it's very congested. Our liquidation still takes so low that it can liquidate all users, and it doesn't matter if the user has $1,000 in debt or $1,000,000 in debt, all of them are liquidating together. So it doesn't really matter. But if you see in many protocol, like, these small users sometimes, they get ignored or they get liquidated in a much worse condition and so on, because it's not beneficial for liquidator to liquidate them right away, right at that time.
So that's another
that's
implication. Basically, the users, not the liquidator, but the users of Fluid actually gets better liquidation price for them.
Yeah. And there is also another thing, which is like the liquidation on Fluid only happens till liquidation threshold. So it's like, if your position is at 90, let's say if the liquidation is at 90% and the liquidation and your position became 91%, then liquidator can only liquidate your position from 91 to 90% back. So they can only liquidate that 1% margin, rather than liquidating like 20 or 50% of the position, which most protocol allows. So if you get liquidated in other protocols, either you lose like half of your position or your entire position. But on Fluid, if you get liquidated, you'll only lose like 5 or 10% of your position at that particular moment. So we have had many users who just lost 2% or 5% of the position in the liquidation before they can come and adjust their position. So the liquidation only happens what's required. So after liquidation, your position is brought back to liquidation threshold. It's not that you got liquidated and now your position is here very safe. It's like very minimal liquidation, and that also is
so it's
possible.
continuously granular liquidation,
Yeah,
just
it's
enough
very
so
granular.
that you can
Yeah.
reach your threshold, not
Yeah.
that, oh, once you trigger the threshold, I'm just gonna take your whole position.
Yeah, it's
That's really
exactly.
smart. Yeah.
Yeah, and it's only possible because of the whole architecture of the fluid.
Yeah.
It's very hard to do otherwise. So, you're liquidating ten users or 100 users all together, and you're liquidating only till what's required, not excess.
Yeah.
So,
That's
yeah.
amazing. Yeah, we should use Fluid versus Binance. So encourage people to check out the summary by Samyak. The next question on architecture is, you guys are going to launch DEX V2, right? And I think there's
Yeah.
quite a lot of innovations coming through. Do you mind quickly talk about, firstly, is there a timeline of when you guys going to launch? And then what are some of the key innovations here?
Yeah. So on the timelines, the goal is to go live by the end of this month, if everything is perfectly fine. So yeah, very close, that means like, 15 days maybe. Um, and yeah, on the innovation side, so our current DEX was like, it was sort of like the DEX V1, it was sort of like to show this new innovation of smart collateral, smart debt, and how it unlocks the capital efficiency. By launching that, we became the second biggest DEX on Ethereum, top five overall in terms of volume. And the DEX V2 basically goes on that same principle, but allows a lot more flexibility to LPs. So currently, you just the currently the sort of limits and the configs were decided by the team, and users can only do supply or borrow within that configs. But in DEX v2, what we are allowing is that any users can create range orders with smart collateral and smart debt. So it will just unlock a lot of new strategies. So if you want to look at like this, like what you can technically, let's say, do in terms of strategies on Uniswap v3 v4, you probably will be able to do 10 times more things here, because you created, let's say, ETH USDC range order, and you can instantly use this range order as collateral, and then you can, let's say, borrow wrap BTC USDC as range order. So you can create a smart debt. So with using this ETH USDC range order, you can create another range order on the debt side of, let's say, BTC USD. You can just create this highly leveraged, complicated position. You can execute different, like, delta neutral strategy, where, like, a lot of the traders who create a position on Uniswap, they go hedge it on perp and so on. But here with the DEX V2, you can create a position here, and then you can hedge it here itself, by, like, you created a position of ETH USDC, you borrowed USDC against it, and then you swap it into ETH. Like, it can be a whole, like, everything can be in a single position. You don't have to go to a per protocol to hedge, or you don't have to do
How do you hedge it? For the examples you mean, say for example, like you're saying ETH
yeah.
USDC, right? And then I
Yeah.
borrow against that position.
Yeah.
How do I create the other leg to hedge it?
Yeah, so that there are different things that LPs uses. Like, there is always some risk involved. So, like, it's not that, it's like fully neutral, no risk sort of thing. But what they do is, like, if they expect that the market is bull and ETH price is going to go up, then they create a position of ETH USDC. They sort of borrow USDC and supply ETH as collateral. So at the same time, they are also going long on ETH while providing an LP position of ETH USDC. So when the price goes up, the entire LP position converts into USDC. So USDC pays back the USDC debt, and then they still retain the ETH with the trading APR and so on. So it's like, there are, like,
Okay.
these depends on, like, where you expect the market will go. You create a position which will suit best to your needs. So sort of like, either it helps to minimize the losses, or like, yeah, just but if the market goes the other way around, then you can lose even more. So
That's interesting.
no,
I guess
yeah.
it's not 100% delta neutral position, right? It's
It's
not,
sorry,
yeah, but
that's probably the wrong word. It's not.
partially mitigated.
Yeah, it's not a delta neutral position. It's I said it sort of wrong. It's like it's a way to hedge your position, like minimize the risk, or like from the LP position, from the market volatility.
Yeah,
So
yeah,
yeah,
makes
more
sense,
like
makes
that. Yeah.
sense. Yeah, I think there's a lot of pretty clever designs that you guys have implemented over the years, because you are so deep into DeFi, right? And you kind of know the
Yeah, yeah.
things that can be done to improve the whole, UI, UX and whatnot. And I think users should really kind of appreciate that as more and more people come into DeFi. Now, I want to spend a couple of minutes talk about economics and traction, because I think today we're back to fundamental season without numbers,
Yeah,
right? We're just not comfortable. We don't want to be trading shit coins and whatnot. We want to talk about
yeah.
fundamental value accrual. So here are some numbers. Today, you have a TVL of 5 billion, borrowing positions of 2.3 billion, last 30 days DEX volume about 22 billion. Last 30 days fee generated 9.1 million. I think revenues are in the range of 1 to 1.5 million per month right now. How much of this is organic? How much of this is well, first of all, kudos to the traction. I think those are impressive numbers, given you guys launched this a year ago or a year and a half ago, right?
A year and a half. Yeah.
Yeah, exactly. So very short time, but great traction. I think more and more people are paying attention to what Fluid is doing and pay attention to the traction. But just maybe to dive deeper into this, right? How much of this is organic? How much is driven by incentives? And where do you see normalized protocol revenue trending?
Yeah. So in general, all our growth and all our users are quite organic. We do have incentives going on, but the incentives are only there on the lending side, which is to lend stables. And it's not particularly to like sustain the growth. I mean, the users who have come, who are using Fluid, will already stay there. But for new users who wants to select Fluid, it becomes like their, with an extra incentive, it becomes their default option. It's like incentives are not required to keep to survive Fluid, but incentives are required for a consistent growth of Fluid. And and we want to focus more on growth, so the incentives are there. Our DEX has currently zero incentives, and it's like doing volumes. It's just truly the technical innovation and everything. And our borrowing side also has, I think, zero or mostly zero incentives in all the places. I know like Ethereum is fully zero. I think Arbitrum is fully zero. Yeah, maybe some other chains have something just for growth, but I expect like on the borrow. So it's like borrowings is fully free, DEX is fully free. We only have incentives on the lending side primarily. And yeah, so because like on the borrower side, we provide the best experience to borrowers, the highest LTV, the lowest liquidation penalty, and so on. On DEX, it's just highly capital efficient, so it's all technical innovation. But on the lending side, our lending APR is similar to Aave. So if you come up with USDC, Aave surely has a more brand and more trust. And if you see like same lending APR on Fluid and on Aave, then you'll probably go land on Aave. So it makes sense for us to like provide 2% extra with incentives to like also for users to be comfortable lending in Fluid. But I think over next 1-2 years, as Fluid also grows to tens of billions in dollars,
Yeah,
we would not need those extra lending APR and so on. So
yeah.
yeah, this is where we are at. It's highly organic. Yeah, we have a good users, good community, and so on. Yeah,
I like that
and
we have a very clear logic on when incentives are used, right? And
yeah.
there's a time period of when this is gonna go out of place. When do we need it until?
Yeah, and another thing is we've also started our buybacks. So
Mm,
the Currently, I think whatever we are spending on incentives is probably around like 1 to 2 million per month. So it's like about like 50 or 70% of the incentives that we are distributing are kind of getting covered by the buybacks. But as we launch DEX V2, as we increase our revenue and so on, then our buyback itself might become more than the incentives, and sort of fluid will go into like this deflationary stage where the token inflation, even with the incentives, the inflation is not there because the revenue generated is a lot more. So we distribute the incentives on the lending side, but we are actually generating revenue from the borrowings and the DEX side, where we are not distributing any incentives. So it's like, yeah, it's growing in a very consistent base. If you see the curve or the graph for last 1 year, you'll see that incentives, emissions, and so on is more or less consistent, but the revenue is consistently rising. So there will come a point where it will just cross, and I expect it to come in within like the mid next year. And once that happens, then Fluid is like a proper sustainable protocol where the business is just like, sustainable. It doesn't need any incentives or anything to survive.
That's pretty amazing. And I think you
Mhm.
guys went through the whole
Mhm.
journey of you launched your token Inst, right? Back in, was it
Yeah, yeah. 2021, yeah.
2021? So went through the brutal bear market, but it was also a good time for the token to go through the distribution, right? So by now, and you guys kind of did a one-on-one swapping from Inst to Fluid.
Yeah, yeah.
And by now, I guess most of the tokens or the investor portions would have vested from memory.
Yeah, so the whole supply sort of circulation, and 25% of the token is still held by the governance, and 75% is with the sort of community investors team and the community, which
Yeah,
is sort of all in circulation. So yeah, it's
yeah.
either governance or circulation.
So I guess for long-term incentive alignment with the community, essentially, for one, you guys have a clear plan to continue to increase the revenue, and we're seeing positive trajectory. Secondly, you
Yeah.
started buybacks, right? So that's going to reduce the
Mhm.
circulating supply. I guess there's very little overhand supply that's going to come to the market because the investors.
Yeah.
I think there's decent returns for investors, and it's been liquid for quite some time, right? So there's no such supply overhang. I think a lot of the crypto holders tend to worry about for some of the recently launched
Yeah, yeah.
that kind of
Mhm.
distribution process over the last 4 years. So I think everything looks really good, I would say, from a fundamental and long-term value perspective.
That's true. Yeah.
Yeah. And I think the
Mhm.
whole DeFi is going through this kind of
Mhm.
renaissance place, right? Because you have clearer regulatory
Mhm.
outlook,
Yeah, yeah.
have clear value capture. I think everyone starts to be convinced with the product market fit of on-chain finance, right? And people think
Yeah, yeah.
more assets going to move on-chain. So I would say there's a lot of positive catalysts, whether it's unique to Fluid, specific to Fluid, but just general towards the DeFi sector.
Yeah, yeah, that's completely true.
Yeah,
Um,
yeah.
yeah, it's highly like it just makes the proper business sense. If I were to put
Finally,
in a
fundamental season. Yeah. I want to wrap
yeah, yeah.
it up maybe with one last question, which is going to be a bit more future forward looking, which is
Yeah,
I think you talk about the vision of Fluid, and it's not just the 3 year, 5 year vision. I think it's basically a vision for the next 10 years, 20 years, right? Essentially, we're
yeah,
going to house a lot of the key financial functions, hopefully integrate that into Fluid if we don't build in-house, but
yeah,
to build as many as possible. What are some of the kind of maybe shorter term plans for the next 6 to 12
yeah.
months from a
Yeah,
integration, from a new product, from a new ecosystem perspective? I guess one example is you guys expanded to Solana a few months back, right? Via
yeah,
partnership with Jupiter Lend, and there has been great traction. So just kind of use this as a specific example, but if you can shed some light in terms of our plans for the
yeah.
next 12 months.
Yeah, so our DEX V2 is going live very, very soon, very close. For next year, there's like still in ideation, but like very high chances that we might have a perp protocol, our own. And again, like in that as well, we will try to innovate,
That
like
is the
make,
alpha.
yeah. In that, we will again try to innovate, like, how can we make from technical or innovation perspective 5 to 10x better?
Mm.
So yeah, we'll take a different route. Users will get yeah. So there is some like positive sort of movement there, but no strict timelines as of now. But we plan for next year. So that's there, and yeah, and there are like fixed rate and permissionlessness on these two things as well that we plan for next year. Yeah. So again, like we haven't decided any timelines, but these three things can be expected for next year, and DEX V2 for this year, and then growth of all of these things, and mini minor things, expanding to new chains, or doing bringing the innovation that we do on EVM side, on the Solana side, and all these things will consistently keep on happening. But these are like the new developments in mind for next year.
So the three key things, I don't know if I get that. One is the DEX version 2. Secondly is the perp protocol you guys are going to launch. The third thing?
Third thing is like we might support the permissionless thing on the Fluid protocol, so anyone can come create their awards. So it's like
Mm,
yeah, so permissionlessness will be there in DEX V2 to
mm.
anyone to come create and the DEXs and so on. But for money market side, we plan to do it next year. And another thing is the fixed rate, because considering the TradeFi institutions coming on chain, fixed rate is something that might be much more needed now than it was like, 3, 4 years ago. So, yeah, these are like all in the timelines for the next year.
Awesome. I'm super looking forward to see what Fluid has in store for us for the next 5 to 10 years. But of course, we'll have you back before that long. Lastly, do you have any call to action to the listeners? Um,
Mm, I mean, just use Fluid. You can do if you're a lender, if you're a borrower, if you're an LP. Yeah, I think it just suits everyone. It provides the nice yield. So yeah.
Awesome. Always advocating for your own product. Use Fluid. Thanks so much. Really great to have you
Yeah,
on.
likewise. Yeah, likewise. Yeah, thanks for having me.